Welcome to Simplify Your Retirement with certified financial planner Stephen Stricklin from Wise Wealth, LLC. In this podcast, we help individuals and couples plan for a peaceful and enjoyable retirement. Join us on this journey where we explore the importance of simplifying the retirement planning process, as Stephen, with his years of experience and expertise in retirement income planning, along with guest experts, will help you achieve first wisdom, then wealth. And don't forget to check out the Simplify Your Retirement online course and other great resources at simplifyyourretirement.com. Now, on to the show.
Hello, and welcome to Simplify Your Retirement with Stephen Stricklin from Wise Wealth. Hello, Stephen.
Hey, Paul. How's it going?
It's going very well, very well. We're excited for today. I know this season we've had a lot of guests on, and today we're going to have another fantastic guest with us, but what I'm excited about is this is another one of those topics that people hear a lot about.
Right.
Maybe it's a good experience that they hear about, and maybe it's not. So I love to be able to have episodes like this where we kind of demystify things for people.
Absolutely. In retirement planning, there's kind of like the things that everyone knows about, everyone kind of has some knowledge about, some experience with, and then there's things that we're going to talk about today that some people don't really know much about, and maybe they've heard things about it. And so that's why today we wanted to clear this up, clarify this, talk about where it fits. For those listening to the podcast today who haven't heard us before, listened to us before, our philosophy and our approach is that there is no such thing as a bad product, only a bad fit. And so there's all kinds of potential solutions out there for people, and we believe it's our job to make people aware of those. It doesn't mean it's for everyone.
Exactly.
It just needs to be the right fit. That's what makes something a good or bad investment.
Absolutely. And sometimes, it's as simple as someone's had a bad experience, let's say with car buying with a used car salesman. And so sometimes even with this topic, it can be a bad experience with who they're working with. So tell us a little bit about the topic and your guest today.
Yeah, and the other thing too is it's like everything else. Sometimes even in the world of used cars, since you brought that up, laws have changed. Right now, there's limit laws. You can't just trick somebody and sell them a bad used car and those kinds of things. So in all kinds of products, all kinds of investments, all kinds of things that people can do to help themselves financially, products and services tend to get better over time. And I think this is certainly, one of them. And so our topic today is on reverse mortgages. And so as a financial planner, obviously we have our own firm here, Wise Wealth. We do, retirement income planning. And one of the things I have always looked at, and we really don't deal with it. And I know our guest is going to be itching to talk about this. One of the things we don't deal with is people's equity in their home.
Yeah.
And so we look at, we're looking at their investable assets. We're looking at how much they have in IRAs and Roth IRAs and brokerage accounts and insurance and things like that. But we kind of just, we take a note of it, the equity that you have in your home, or if there's any debt, but really kind of just sits there. And so maybe there's some better uses for home equity. And that's the entire point of today's show.
Yeah. And working with so many people across the years, we've seen some people who that is their biggest asset in retirement is their home. And for a lot of people, though, it's just another piece of their asset puzzle.
Right, part of their net worth.
Yeah.
And so that's why I'm glad today to have Gabrielle Welter. Gabrielle Welter is a reverse mortgage specialist. She is outstanding when it comes to educating people on this. She's all over social media with some great videos and content all about reverse mortgages. And Gabrielle, I'm so glad to have you on our podcast today.
Thank you so much, guys. I'm so excited to be a part of it.
Absolutely. Look forward to it. Gabrielle is married with 3 boys. And then also I hear that you have one super cute golden retriever.
We can't forget her. She's become a big part of the family and requires the most attention now.
Right. So she's the girl. You got 3 boys and 1 girl in the family.
Right. I had to even it out a little bit,
Busy household. So Gabrielle has 11 years of financial industry experience, beginning work in the life and property insurance industry. And she also owned her own Allstate agency for 5 years before becoming a reverse mortgage loan originator. And she does this for her. It's not just a transactional, relationship. It's something that is meaningful. She loves helping people understand reverse mortgages. She loves helping people know whether or not they should to look into this. And she helps people and really tries to establish a relationship. It's not a customer relationship, but it's a client relationship, just like those that work with Wise Wealth. She does have a great website. Before we get into the content, her website is myhousecounts.com. myhousecounts.com. So Gabrielle, with all that being said, you want to just give, everyone just a brief overview of, what is a reverse mortgage? If this is the first time anyone's finally going to look into this, what would you want them to know about a reverse mortgage?
You guys did a great intro on the product and talking about the fact that it's true. So often home equity is overlooked. And unfortunately, the reverse mortgage, when it was first originated and out there, there were some mishaps along the way. So over the years, there has been different rules and regulations implemented to protect seniors and the borrowers. So the biggest thing would be just education for the seniors, that they don't need to be afraid. And people, a lot of times they think of if somebody is sitting in a home that's paid off, right? That's an accomplishment, I'm sure, as investment advisors, right? Are you probably a lot of times when you're sitting with your client, if you're talking about the home, that's a goal. And then they look at utilizing a reverse mortgage as taking on debt again, almost like a step backwards, right? It's nicknamed the loan of last resort. Like it's for the people that need money desperately.
Right.
And it's just not the case. It can be applied like that. I mean, I did have a client whose home was sold at tax sale and it was in the redemption period, and we got the check there to pay off the taxes by utilizing the reverse mortgage at the last minute. But more often than that, it's just an excellent way to actually enhance the retirement portfolio overall.
Right.
And so we need to change that perception,
Absolutely. And so, I know a lot of times we look at, someone's home equity and it's kind of like a dead asset. So, if you have $200,000, $300,000, $400,000 or more of equity in your home, what is the value of that to you?
Correct.
And so exactly. So people could utilize that. And what are some things that people do? Let me start with that. What do people do with it? I can think of a lot of things people could potentially do with the equity in their home that would actually be, let's say, better for the beneficiaries, that might be better for their own, financial experience in retirement.
Right. Well, and like Paul said, so many people out there, the majority of people, the home is one of the biggest assets they have in retirement, right? So instead of saying, okay, home's paid off, no mortgage, check, take a real look at that. So first, I just want to clarify and state that some people think that a reverse mortgage can only be utilized when the home is paid off, but it can also be implemented if you still have a remaining mortgage. So as long as the appraised value of the home demonstrates around 50% equity, then you can still put a reverse mortgage in place and eliminate the existing mortgage payment.
Okay. I want to come back to that. Because that's a good point. Because I think a lot of people believe, you can't get a reverse mortgage unless you have no existing mortgage in your house. So I will come back to that. But one of the things I look at, for people, let's say either way, they want to tap into the equity of their house. They could take that money and let's say they need, long-term care.
Exactly.
You could use that money to buy long-term care insurance. You might be able to use that money to buy life insurance. You might be able to use that money to increase your, income stream in retirement. So there's a lot of uses for the equity in your home.
Correct. And you know what, Stephen, a lot of times, it's very common to find seniors with homes that are paid off, but they have home equity lines of credit. Very common, right? Maybe they got like 20,000, 50,000, whatever.
Right.
They take from it, they pay it back.
Yeah.
And the thing is you can use that same strategy with the reverse mortgage, and this is huge. There's no payment required on that money you're using.
Right.
So, gosh, I forget. I just heard something the other day, but it was a statistical number, on how what our chances are as a senior to, need some kind of care, have some type of medical event. I think it's like 70%.
Yeah, that's right. Yeah, and that's what we teach our people. There's like a 70% chance that one person over the age of 65 is going to need some sort of like long-term care services in retirement.
Yeah, like you said, you can use that money to help pay for it, or even if you didn't have the long-term care insurance in place, what may be okay, a payment on your home equity line, even though it's usually interest only, it can't go on forever, right? It amortizes after like 10 years. And it's just a good rule of thumb is not to acquire more payments in retirement, right? You're trying to increase the cash going in and reduce the cash going out.
Yeah, that's right. For most people, we're trying to reduce the expenses or increase the income because of inflation and other things like that. So it's nice to have possibly an extra source of money, an extra source of income without adding an extra source of expense. That's a very good point. That's another great way to look at that. And so one thing that I know that you've mentioned a couple of times is you're mentioning seniors. So I want to make it clear, what is the age, what's the minimum age for someone who even qualifies for a reverse mortgage?
So there's a few different reverse mortgage products out there. The HECM reverse mortgage, which is the home equity conversion mortgage, that's FHA insured, their requirements are 62 and older. So one spouse must be 62. There are some other proprietary products out there that go as young as age 55.
Okay. But typically you got to be age 62 to qualify for a reverse mortgage. And then you mentioned something, a minute ago that I said I was going to come back to, and now I'm going to do that. So let's say someone has an equity in their home. Let's say it's $400,000 and they still owe $100,000. So they have $300,000 of equity, even though they still owe $100,000 on their primary mortgage. How would something like that work? Does the reverse mortgage take the $100,000 and maybe add another $100,000 to it and give them a reverse mortgage for $200,000 so they have $100,000 free and clear?
Yeah. So what we'll do is we'll look at so if the appraised value was $400,000, they owe $100,000 on it. So the way the reverse mortgage product works is it is age-based and loan amount-based. So the older you are, the more, we call it the principal limit. It's the higher amount that you can access of that home equity. So somebody, 62 versus 82, the 82-year-old is going to be able to tap into a little bit more. But in a typical situation, let's say they're 62, we're going to take about 50% of that. And so they've got access to around $200,000. And then we would pay off the existing mortgage, eliminating the mortgage payment, property taxes, homeowners insurance. That, of course, still applies. And then we would cover the closing costs in that money. So there's no funds out of pocket at closing. And then the remaining amount of money is available.
No, that's very good. That's excellent. So, for someone in that scenario, they still owe $100,000, but they have equity of $300,000 in the home. The appraised value is $400,000. They could literally eliminate that mortgage payment and get an extra $100,000 just to be able to use for, whatever reason. So they eliminate an expense and actually get more money in their pocket.
Right.
Just by utilizing this quote unquote dead asset.
Exactly. That's what typically, we can't, we're all thankful for the growth in the housing market, in the past, 18, 24 months, but it's not typical. So by default, traditionally, the home is not going to be your highest earning interest asset, right?
Right, exactly. And so, you could take the money that you got from the reverse mortgage and invest that. Like you said, you could use it to purchase maybe some things you need in retirement more than the equity in your home.
Correct.
And we mentioned a couple of these long-term care life insurance. And so I'm going to stick with this example. Let's just say someone has a $400,000 appraised value. They get a loan for $200,000 on this home equity. And I also want to make clear, this can be a loan where someone literally gets a check for $200,000 that they can do technically whatever they want with, or it could just be a line of credit. They don't ever have to use it.
Exactly. And the cool thing about that is, so your loan balance could initially be just the closing cost, that's it. And that money's just sitting in a line of credit. And the line of credit experiences some growth, meaning let's say that $400,000 home that you have and we close on it. Now there's $100,000 in the line of credit, right? And you just let it sit for 10 years. It actually will tap into that remaining equity in the home that was left in reserve.
Right.
The point of this would be you're not like stuck.
Right.
Meaning, if I do a reverse mortgage at 62 until maybe I'm going to wait 5 years or 10 years and let my loan balance decrease on my mortgage and let my home increase.
Right.
No, because that line of credit will grow and you'll still be able to tap into that home equity growth.
Absolutely. So great example. So whether it's 100,000, 200,000, if someone got it at age 62, at age 72, if they had not touched it yet, that credit limit should be higher than it was when you got started.
Correct.
Because the value of your home is higher.
It will be. Yeah. Yeah. You will watch it grow every year when you're not using it.
Yeah. That's awesome. And so you're only being charged interest only on the money that you actually borrow, like any other loan.
Right.
And you mentioned a second ago, closing costs. So I think that's one of the things that people hear about sometimes. They're scared to death. They hear that, the closing costs or the cost of the origination and so forth on a reverse mortgage is, higher than typical or whatever. What can you tell us about the closing cost on a reverse mortgage, whether that's a straight loan or a line of credit?
So yes, often the people don't know a lot about a reverse mortgage. They will have heard that they were expensive. And the truth is that yes, the cost to close a reverse mortgage the fees are more than a traditional loan. There's reasons for that. The loan, like I said, is FHA insured. It is a non-recourse loan. So, which means that they cannot pass any debt to any heirs. So if, for example, the home, let's say, people talk about like, is the housing market going to crash? Okay. Right. Like now, like you hear that and we all remember the crash in 2008, 2009, whatever. So for some reason, let's say somebody has a reverse mortgage for 15 years and they pass away and the loan balance has accrued to and is now more than the home is worth. They won't pass any debt to any heirs. The insurance takes care of that.
Right.
And, it's a zero balance. So there's a reason for those costs that, why it's more expensive. But let's talk for a second about what cost means.
Right.
I mean, it's value, right?
Yes.
Something's expensive when it's not worth it.
Yep, that's a very good point. I get what you're saying. So, because some things are, it's expensive because it's not worth it. But if there is something you're getting a value, you definitely have to pay for it.
Right. And I just actually did a LinkedIn video on this morning, but the benefit of the reverse mortgage can far outweigh the cost of doing it. And when you look just at the sticker price of it, and ignore what the actual true value add is, in the bigger picture, you're very likely to have more money in the retirement portfolio when you utilize it and strategically implement it, like you talked about. You can use a product wrong.
No, I get that. I think that's extremely important to analyze that, not just look at something and say, "Yep, it costs too much. I'm not going to do it." They got to analyze what are they getting for that price they're paying. What are they going to use with the proceeds of that investment? Would it far outweigh the cost of getting the loan and so forth? So I understand totally. And don't just, say, forget it because it's going to cost too much. But generally speaking, is there a rule of thumb? Is it 2% of, the appraised value? Is it 2% of the loan value? Is it 5%? Is there a general rule of thumb what it might cost?
So one thing that is steady is there is a 2% fee for the mortgage, the MPI, which is the mortgage protection insurance that is paid at closing. So that's going to be where the bulk of that fee comes from.
That's the biggest expense. And it's just on the value of the loan.
It is actually on the appraised value of the home.
On the appraised value. Okay. All right. Very good. So in other words, that's good. I think that's what people need to know that, because like we talked about at the beginning, it's like everyone just, hearsay, they hear things about it. It's like, I heard it costs too much. I'm not even going to look into it. So you've got to look into it. You've got to know the number. And
what's the cost not to do it?
That's right. Exactly. That's like with everything else. You got to weigh out, what is the cost to do it? What is it going to cost me if I don't? Very good points. That's great to know. And I think you bring up a very good perspective on it. And I think you've got some calculators even on your website at myhousecounts.com. I want to remind everybody that we are talking to Gabrielle Welter, reverse mortgage loan originator. She's out near Chicago, and her website is myhousecounts.com. By the way, are you licensed to help people in other states, or Do you have people you refer to in other states?
Yeah, I am. I'm licensed in Indiana, Illinois, Wisconsin, Minnesota, Florida, and then Arizona, Texas are pending.
Okay. So Missouri, Kansas, where we are, you have people that you could refer, clients to if someone contacted you from here.
Well, yeah. And actually, Stephen, it takes me about a week to get licensed.
Okay. I gotcha.
So yeah, I would
perfect.
just get licensed.
Excellent. Yeah. So you can visit her website, myhousecounts.com. She has a lot of information about reverse mortgages. So just want to remind you guys of that. So this is, fascinating discussion. So you mentioned a second ago that this is an FHA loan. I mean, this is a, federally insured loan. And I think that's something that's extremely important for people to understand. And you alluded to it earlier. And that just means that you're never, I guess there's two things I always look at as a positive to it. One is there's never a scenario where you're going to have to be forced to move out of your home. I guess that's one, kind of a statement question. And the other one is you're never going to owe more than what the house is worth. I mean, there's not going to be, you cannot pass on a debt to your children in an FHA reverse mortgage. Are those two statements correct?
Correct. So there are some minor regulations that you have to follow, which is the home must remain your primary residence.
Right.
And you must maintain it.
Right.
To FHA standards. That's it.
I gotcha.
As long as you are, and you have to pay your property taxes.
Taxes and insurance. So outside of the loan, you're still paying your own property taxes and insurance.
Correct. Those never go away.
Right. Exactly. So you keep up with that. You're maintaining the home as long as you're doing that. In other words, they want to protect their investment. Their investment is in the house. So theoretically, let's say both of you are alive. So one spouse dies, the other spouse is still in the house. The second spouse dies at age 95. They took out, a $200,000 loan at age 62. And now it's 95. They didn't make any payments. And so that loan has been accruing, and maybe the house was worth 400 at the start. And maybe by the time they're 95, it's worth $1 million. So they're going to take the appraised value, subtract all the loan payments. And if it's a positive number, what happens if they sell the house and there's still equity in the home? Where does that go?
Yes, I'm glad you brought that up, because one of the other really common myths is that the bank owns the home. And that's not the case. The title on a reverse mortgage it's just like when you do a regular mortgage on your house. So they don't want the house coming back to them, right? So let's say both borrowers pass, and the home then has the heirs, whoever it's left to, they have up to a year to either sell it or purchase it. Now that time frame begins with 3 months, and then there's some extensions. Okay.
Right. I think that's important for people to understand that if there's still equity in the home because the house grew in value or the loan, wasn't as high as it's not like it's not like you're giving up the entire equity in your home. Whatever equity remains is going to your beneficiary still.
Yes. And so often people think that it's just, like we said, check the box for if the mortgage paid off, or cross it out if you do a reverse mortgage. Then that's not the case.
Yep, that's
not the case. We do an amortization schedule, like when I'm doing a proposal.
Yes.
So just like on a traditional mortgage, of course, it's hypothetical because we have to assume value and everything like that. But you would be surprised at how often there is significant remaining equity in the home.
That's a good point. So if it's a positive, at the end of the day, the house appraises and it sells for more than what the reverse mortgage loan payoff is, that equity can still go to the heirs. But if it's a negative number, the house, appraises for, $800,000, but you owe $1 million. That's where the insurance comes in for the FHA. The heirs aren't responsible for the $200,000 loss.
Right. And anybody in the financial industry knows that time is your friend, right? You need money in, and you need it in. The longer, the better, right? For growth to occur. So imagine you do a reverse mortgage at 62. And you do take a chunk of that money right away, and you put it into an investment that is earning a higher return than, we average on our home. And it does that for 10, 15, 20 years.
Yes.
You actually have more possibility of increasing the legacy and the amount that's left over for the retirees and for the heirs.
Very, very good point. It's interesting you say that, because a lot of times when I talk to clients and we're looking at their, financial picture, the question would be, what's the plan for the house? And a lot of times we hear people say, well, we're going to leave the house to the kids. We're going to leave the house to the kids. And you think to yourself,
what is the kids want the house?
Right, exactly. What exactly does that mean? We know all 3 of your kids aren't moving back into your house, right? So it's like,
yeah.
So what people mean by that is they're not leaving the house to the kids. They're leaving the money, the value of the house to their kids.
Exactly.
And so I think that's the analysis that people need to have and say, look, what is more valuable, leaving the house to the kids or leaving this investment that I grew for the next, 20 or 30 years to the kids, or the life insurance policy we bought to the kids?
Really. And exactly. And then all you have to do is divide by 3 or divide by 4 or whatever the calculation is, rather than, are we going to sell the house with the realtor or
That's
no?
Right.
What do we want to list it at? You know, do we need to fix it up first? I mean, how many stories have we heard of families that divide after a parent or both parents pass?
Absolutely. So I think that's a very important consideration. Another one is, I know you mentioned you have a lot of clients that have $1 million homes that go ahead and get a home equity. It's not a loan of last resort. And I know that's one of your big things. You don't like when people say, oh, this is the last thing you do. You only do it if you have to have it. So there's a lot of people that will go ahead and just get the line of credit, get that established early, have it there, whether they ever use it or not, doesn't matter, but they can tap into that at any point in time. And whether they use it or not, they may have to pay the closing costs, but at least they have this asset available to them if they ever need it, want it.
Right. I'll give you a great example of somebody with a $1 million home or $2 million home that uses the reverse mortgage. Let's say you tap into that and you use that money to buy a second home. Mm-hmm. If you're looking at, buying a second home cash and taking that money out, or utilizing the home equity to do that, it can provide that. Another opportunity would be, we call it passing money, passing it down with a warm hand instead of a cold. It's kind of, it's not super warm and fuzzy.
Yes.
But, instead of like seeing that, that sigh of relief or gratitude or excitement at, hey, guess what? Your mom or dad left you X amount of money, help pay for a down payment on the house, or take a family vacation, or pay for your grandchild's, college education.
Oh, awesome. I love all those things, Gabrielle. That's awesome. Great ways to think of it. College education, take a big family trip. Yeah, it's going to come out of the equity of the house potentially, but you did something for them while you were alive. While your hands were warm and not cold, Paul. I never thought about that one, Gabrielle. It's a good one. We'll try to remember that one. One more thing I wanted to talk to you about. This has been outstanding. I think this is going to be extremely helpful to people to understand, to look into. And I would just suggest that, that they contact you. Go to myhousecounts.com, get a hold of you. You explain these things very well. You want to give people education. You want to give them the options. I think you'd be a great person for our clients and people listening to the podcast to work with when it comes to looking into a reverse mortgage. One last topic I did want to talk about before I let you go, and that is what they call, a HECM for purchase, using a reverse mortgage actually not to take equity out of an existing home, but to actually buy a new home. Can you just explain that real quick, how that works?
Sure. So one of the big problems for seniors is, especially now with housing values on the rise, is, well, even everybody, right? It's like, geez, you can sell your house for a lot, but you have to spend a lot to buy a new one, right? Yes. So one of the things that seniors face is their home being suitable to their needs. And so if they find themselves in a situation, they're living at tri-level or bi-level, they need a ranch, whatever, but they don't have, they only have the money from the sale of their house. So let's say they have a $200,000 house, but they can't find what they need for $200,000. Or somebody maybe is relocating because they want to be closer to the grandchildren. So they're going to change states or areas, right? But housing values are more expensive there. With the reverse for purchase program, or it's called H for P, you can actually do a reverse mortgage and close with it. So what you do is you come to the table instead of like 3.5% down, FHA conventional 20% down. You come to the table with that 50% equity. So if you can sell your home for $200,000, or you need to take some money out of investments to help fund this too, but you can actually purchase a $400,000 home or $450,000, depending on your age, and not have a mortgage payment.
Right. Very important. That's huge. How people understood what you're saying there. So someone could buy a $400,000 home with only $200,000 of cash, either the equity from the home they sold or from, cash they had in savings, and not have to pay back that other $200,000. They have a $400,000 home that they only paid $200,000 for.
Exactly.
That's huge. And really, that's very interesting, even in the environment that we're in currently, where people are saying, well, I can't sell my house now, even though the value of their house is the highest it's ever been, because they know they have to turn around and go buy something else. And so this could be another example where you could sell your house for, your highest, level ever, take some of the equity, buy another house for cash for only half the amount you might need, and so forth. So that's a very, very good concept. And I know, Gabrielle, there's a lot more. I mean, you talk a lot about reverse mortgages. You do it all day, every day. I know, I see you out there on social media. I know you love this topic and you're an expert on it. So thank you for joining us on the podcast today.
Thank you so much for having me. It was so much fun.
Absolutely. Really appreciate it. If you want to get in touch with Gabrielle, her website is myhousecounts.com. And Paul, obviously, if anybody needs to get a hold of us here at Wise Wealth, the website is wisewealth.com. And again, we talked about at the start of the show, it's been great to have different guests on, just cover different topics that people sometimes, don't talk about, they're afraid to talk about. And we feel like our job and our role here, especially on the podcast, is to make people aware of different, products and different investment solutions and money solutions that are available to them.
Absolutely. And it all fits within the context of a plan, though, too. So we don't bring up these topics just for the sake of bringing up topics, but rather, or introducing products, but really talking about what are the ways that we can solve the puzzle in a sense, right? So these are all just answers to the overall planning question, which is what we're talking about, the plan. And so, I appreciate you, Gabrielle, for being on today. We will, in the show notes, have links directly to it. I know you've spelled out the website and all that, but we do have links right in the show notes to that. We also have a link in the show note to be able to request a copy of our book, Simplify Your Retirement, where we talk about some of these topics, certainly not as in-depth as this, and that's why we have the podcast, so that people can continue to learn and grow. And I appreciate the educational approach that you take, Gabrielle. And it's, I don't feel like if anyone clicked contact me or they talk to you, that they're going to feel like they're being sold something. And that's a key thing for us as well.
Yeah, it's not about that. I mean, especially with a product like this, individuals have to feel compelled and safe. It's about peace of mind, and making them feel like they made the right decision and that their retirement future is better because of it.
Absolutely. That's awesome. Thank you very much.
Yeah. Well, and so again, thank you. Thank you, Stephen. Thank you for having great guests on as always. And, of course, our last thank you goes out to you, the listening audience. Really, you're the reason we do this. We wouldn't be here without you. Thank you for tuning into the Simplify Your Retirement podcast with Stephen Stricklin. If you haven't subscribed yet to the podcast, please click the subscribe now button below. This way, when Stephen comes out with a new podcast, it'll show up directly on your listening device. It also makes it much easier to share podcasts, especially one like this that a lot of people are going to want to hear. So again, thank you for listening today. For everyone at Wise Wealth, this is Paul Brock reminding you that financial peace comes from having a plan. And we'll see you next time.
Thank you for listening to the Simplify Your Retirement podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Wise Wealth LLC or Simplify Your Retirement. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of a financial advisor or other qualified financial professionals with any questions you may have regarding your investment planning.